Global logistics real estate company Prologis out with second quarter results this morning, topping expectations. Funds from operations coming in at $1.11 versus 99 cents expectation. You can see the stock is surging. Pre-market up by more than 3%. Market cap stands at about $70 billion. By the way, it's integral to companies like Amazon, UPS, FedEx, and Pepsi getting their products to customers. Joining us now to talk about the quarter and the renewed focus on supply chain efficiency during the coronavirus pandemic, Hamid Moghadam, the chairman and the CEO of Prologis. Hamid, great to have you with us.
Good morning, Melissa.
Talk to us about trends, because you did provide full year guidance of 370 to 375 for the full year for funds from operations. And in the press release, there was commentary to the effect that based on proprietary data and the trends that you're seeing, that you're even more optimistic about the back half. So what specifically are you looking at?
Well, Melissa, we started the year with a very optimistic outlook. And of course, all of that was before COVID. And when we got to the first quarter results, they were strong, but our outlook, we softened it a bit because nobody really knew what we were facing. But as the business has progressed in the second quarter, we're finding that demand for our space is actually increasing because e-commerce is growing much more rapidly than it was before. We probably got 3, 4, 5 years of growth in a quarter or two. And e-commerce is a big tailwind for our business. It's a pretty good business otherwise, but e-commerce just supercharges it.
What are the trends that you're seeing in rent deferrals? I understand rent collections were something like more than 97% in April. They went down to 95% in May. What are you seeing in June and the early parts of July, especially as the coronavirus has, we've seen cases spike across the country?
Yeah, actually, we run a global business. And if you look at our collections globally, and the U.S. is actually stronger than the global numbers, but if you look at the overall numbers, they are actually running better than last year, which was a record year. Now, you might ask why in an environment like this, collections are running ahead of last year. And the reason is pretty simple. Our business is vital to the supply chain. And even people whose businesses are not doing well have to keep their inventory somewhere. And that's usually in one of our buildings. A kind of an interesting statistic is that 2.5% of global GDP goes through our billion square feet around the world. So we've got pretty good visibility as to what's going on in the global economy. And, both on the good end and the soft end, people need inventory and need a place to store their goods.
Speaking of the softer areas, I'm wondering if you're seeing in any submarkets increased pressure. I'm thinking of a market like a Houston or places in Texas where they might be hit by the pandemic, but also by falling oil prices.
You hit the nail on the head. Houston is probably the softest market in the U.S. And if you sort of expand the discussion globally, I would have to say France is probably one of the weaker markets. But generally, through this cycle, we've held up pretty well around the world. And I think the primary reason is that unlike other cycles, supply of space was very tight going into this downturn. Vacancies were under 5%. Utilization rates were in the mid-80s. And both of those are records. I've been doing this for about 37 years. And those are numbers that are unprecedented in our business, unprecedented good.